Position sizing. 90% of your duty is to avoid the landmines. Take care of the downside and the upside will take care of itself. A simulation was exercised where traders were given the same amount of money, $100,000 each. After 50 trades were placed, the results were astonishing. They ranged from bankruptcy to $13 million. This just goes to show how important position sizing and individual psychology really is. Given the chance to make a trade, many traders and investors would jump right in, risking a substantial amount of their capital. Why? Well, because that particular stock or recommendation was made by some friend or a hotshot advisor or a newsletter, or it just sounded like a great buy. Because there was no exit strategy or plan B when the stock didn't go up or rocket into the sky and problems started. Or because when a stock goes against the original plan, things turn sour. And when things turn sour, human psychology shows that we're bound to make it worse. We don't sell soon enough. Taking big risks and risking a large portion of your trading capital is foolish. What makes things worse is that traders and investors who don't understand human psychology and attraction towards loss dig a deeper hole. And before you know it, they're bankrupt. How many shares or contracts should you take per trade? Most traders don't know how to answer this question properly. The following section will save your life so you can fight the battle for another day, literally. Position sizing forces you to be rational and protects you from the biggest enemy, you. We don't have a crystal ball and we don't have information of the future because we don't know how the stock will go up or which stock will go down. This strategy helps remove extreme volatility in your trading. In short, you don't want to over-own a loser and under-own a winner. And this strategy helps for both small and large accounts. Trust me on this. I learned this the hard way, and if I learned this earlier, my life would be far better now. So, what is position sizing? Well, it tells you how much for each and every trade. Position sizing will help you determine how much money you can risk losing and prevent you from taking big bets that could wipe you out completely. Remember, your gunpowder is your trading capital. It's your inventory, so don't blow it up. Preservation of capital is the most important concept for those who want to stay in the trading game for the long haul. It's probably the most essential part of your trading system. Position sizing is currently being taught by Dr. Van Tharp. If you want to learn more about trading, you have to learn it from him. I'm saying this for sure. But in short, position sizing refers to a position within a particular portfolio or the actual amount the investor is going to trade. This is a money management technique used by professionals that will help you tremendously. We don't have a crystal ball. We don't know which stocks will do good and which will do bad. But if you have an equal amount in each one, so no one stock will put you out of business or make you bankrupt, you're good to go. First, we need to differentiate between risked versus invested. Let's take an example. Say you have $100,000 to play with. First, you decide how much you can risk. Remember, there's a difference between risked amount and invested amount. Don't confuse the two. Risked amount is the amount you're willing to lose. Invested amount is the amount you're testing your trade or idea with. If you're ready to lose 2.5% of your investment on any trading idea, that means you can sacrifice losing, say, $2,500 from your total portfolio. If your funds get bigger, you can play with bigger amounts, but your risk is always going to be 2.5% on any one trading idea. Now, if you follow a protective stop, and you should be, of 25%, then that means you're out of the trading idea when you lose 25% on a single position. So working backwards, that means if you have invested an amount of 2,500 divided by 25 or 10,000 in a single trade, this also follows our strategy of diversification, where you should not have more than 10 stocks in a portfolio. Let's look at this again in a more graphical way. Your risk amount is 2,500 of the 100,000 portfolio. That's 22.5% of your total portfolio. Okay? Now, if you apply a trailing stop or protective stop of 25%, that means that 2,500 is the risk amount and the invested amount is $10,000. So your invested amount of $10,000 is 10% of your total available trading capital. Or, in short, we can trade 10 stocks. Okay, so how do you actually do position sizing? Well, there are three ways, but the one I prefer is percentage of portfolio. I prefer percentage of portfolio because I believe as an investor, things should always be thought of in terms of percentages and probabilities. The second one is the fixed dollar amount or risk capital. The problem with the fixed dollar amount or risk capital means that let's say you start with 10,000 as an account. If you risk 1,000 on a trade, let's assume that all those trades fail, you have just 10 trades to make. That's it, nothing else. However, with a percentage of the portfolio method, you're actually forced to take a lesser risk each time. Let's take an example. 2% of 100,000 is 2,000. If you lost a trade and your position was wiped out completely, you'd still have $98,000 of trading capital left. Your next trade would be 2% of that 98,000 capital, which is, if my maths is right, 1,960. So you're risking less now because your last trade reduced your trading capital. This forces you to take lesser risk. If you lose that, you end up with $96,040. And for your next trade, you're going to take 2% of that, which is 1,900. I hope you get the picture by now. Another method is the fixed dollar amount, but I'd advise against this as well. You may be thinking, how am I going to be making money with these small position sizes? Well, hang on there. Let's take the other side of the coin. And when you reverse this and you prove to be more and more successful with each trade, you can afford to risk more. So let's say you earn 60% on a trade. It's possible with options. You get to increase your position size to 3,200, which helps you build your momentum as your portfolio or trading capital grows. There's a nice saying, trade small, trade often. Now you know what that means. In short, you're purchasing $10,000 worth of stocks or 10%, but you're risking 2,500 or 2.5% of your portfolio. Okay, this is not as sexy as putting a substantial amount of money and betting big, but we're here to protect your capital, to preserve it. As we call it, keeping your gunpowder dry, so that you'll have capital to play with in the market over the long term. What happens if you blow your trading capital away? Well, you can put in some more money and repeat these costly mistakes again. If you don't have money, you might end up searching for a job again, just to build up your trading capital and gunpowder. I know many traders who had to follow this route. It's not a nice sight, and they end up depressed, some giving up trading altogether. Again, very few make money by trading short term. It's the long term that pays off.